The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Buy the dip or bail out now. A rudderless market drifts the sea toward the end of a record year. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. So poetic that was.
Thank you very much.
You're quite welcome. You know what's leading the market? That yield curve. That's what's going to give it some direction, and that's what's really causing some confusion, Romaine. It feels like this is the highlight of the day. It's a 210 spread, moving by about 10 basis points. A pretty solid steepener. The steepener we haven't seen since June of 2022, and that's causing some confusion in stocks, right? You have utilities, tech, and financials all doing well. That necessarily doesn't make sense to me, and the dollar is getting dragged along with it. That's having ripple effects across other markets as well.
Yeah, the dollar and, of course, that yield curve, a big part of the story in equity markets with stocks right now trying to stabilize after that big plunge on Wednesday that pushed it to a very perilous place following a 2-year bull run that, well, has been virtually unrivaled in recent history. But here's the thing. Rebounding off of yesterday's low, it's proving challenging given some of the disappointing earnings we got after the bell last night from Micron, Lamb Weston, and Lennar. We're going to try this again tonight when we get Nike and FedEx. They have a chance to really help or maybe hinder the rally when they report quarterly results in just about an hour's time. Now, one fly in the ointment of corporate earnings, though, has less to do with earnings and more to do with the economic game of chicken down in Washington. The president-elect being handed a great economy. That's based on updated GDP figures today, showing that the economy expanded at a faster pace in the third quarter than previously estimated. However, the steepening of the yield curve, like Alex was talking about, shows traders are apprehensive about some of the White House policies that they say could reignite inflation. In addition to that, there is material concern that those same policies will in turn worsen an already large federal budget deficit, concerns that prior to today was largely about a future budget battle months and months away. Well, guess what? Surprise. President-elect Trump and Musk throwing Washington into chaos right now just before the holiday recess, demanding a rewrite of a key budget compromise that was designed to avert a government shutdown this weekend. And that's moving markets. Alex?
No kidding. It has been quite a tremendous 24 hours within the market. So it raises the question in terms of policy and the Fed versus earnings, right? If you think that the fundamentals of earnings are going to be really good, maybe the other stuff matters a little less. I guess the question then becomes, what's earnings consensus? And this comes from Bloomberg Intelligence that shows the earnings consensus for next year is coming in at about 13% for the S&P. However, they take a look at the value of the S&P right now, and if rates hold, they say that you should see increased earnings up to 23% based on current valuations. And we haven't seen that since all the way back in 2021 and also all the way back in 2018, which the question then becomes, can we get there if rates hold? Or are we overpricing the positives of what we may see out of Washington, Romaine, right? That corporate tax cut going to 15 from 21 is very different from 35 to 21. And then you overlay a government shutdown and uncertainty in the long end of the curve. And maybe that consensus looks a little odd.
Absolutely. Certainly with positioning stretched right now and the demand for loss protection pretty much muted. Aaron Dunn joins us right now here on this Thursday afternoon. He's co-head of value equity and senior portfolio manager at Morgan Stanley Investment Management. All right, Aaron, I'm sure you heard what we were just talking about here. You look at positioning, you look at, I guess, some of the optimism and euphoria in this market. It's a bit lopsided, Aaron. Does that give you any concern?
It does. There's a couple indicators I'd point to that really concerns me. One is, I think the U.S. ownership, retail ownership of equities is really back to prior highs. So I think people are fully invested in this market. Another is, I think there's consensus bullishness largely around the marketplace, and we meet with companies and investors, and it just seems that everyone is really nervous about going against this market. So I think you've got a very consensus bullish long here, the market. So that also worries me. I think you've got margin lending that's pushing really high levels. So a lot of indicators we would look at to say this market it's a little worrisome from some of these indicators. And I think when you look at valuation heading into next year, that's also not a tailwind. If you go back to 2016, we saw a similar trade up and sort of risk, I think, after the the last Trump victory, we've seen a very similar move this time, and then that was sort of the peak, and we went down from that level.
A little bit different this time because we're starting from a different place in the market than where we were in 2016. And of course, with all the concerns about a potential debt ceiling showdown this weekend, and of course, some of the policies that a lot of folks think are going to be inflationary, there's this concern that some of the negative policy positions, if you will, could outweigh some of the more positive ones that were sort of tied around that idea of deregulation and a more business-friendly administration. How do you balance that out as an investor next year?
Well, I think we really focus on bottom-up stock picking. So that's one thing I think we really focus on. But I'll say from a policy perspective, this administration is going to use policy as a negotiating tactic. So I think you have to enter this administration understanding that. That doesn't mean they won't execute on a number of things that they're going to do, but I do think they are hamstrung in some sense by, budget deficits at the government level that are going to need to be addressed. So, through this significant tax cut or broad-based tax cut, we would probably say we're reluctant to believe that happens. Tariffs, likewise, you've seen some moves out of Canada to sort of address that. So we think there's some agreements that are coming to place to prevent a lot of this. Now, I do believe tax cuts for, say, domestic production happen, right? So there's areas we will see the benefits. That deregulation part is probably the most meaningful. And if you look at where it's most meaningful, it's really meaningful for mid caps that are most, I think where the business optimism has really jumped quite a bit. So we would point to that as maybe an offsetting factor.
So, Aaron, with specific names, what names make the most sense? Because you want some that will participate in the upside, but then be protected from the downside and sort of any macro headwinds, right? So from a bottom-up consensus, what do you like?
Yeah, so from our perspective, what we really focus on, we want to own quality businesses to begin with. So we're looking at good return on invested capital, good balance sheets. They generate free cash flow. This keeps us out of real trouble and cyclical downturns. So we tend to outperform in that sort of environment. But so a couple of names I point to, like a Robert Half. It's their net cash on the balance sheet. It's a real asset-light business model that earns very high returns on capital. And the stock has really gone nowhere for quite some time. There's a lot of heavy insider ownership as well. And, employment we've seen has really held in quite well. And so if you want to take sort of a balanced approach of, I don't want to get caught in a negative market with a really bad balance sheet, but I do want to participate in the upside should employment remain very strong in the economy to do well next year. Robert Half is a name we would throw in there as well. Another one would be Mettler Toledo. This is, if we see a resurgence of onshoring CapEx in the U.S., and also, I think, really looking globally, a reacceleration of stimulus in some of these economies in Europe and maybe Asia, you could see CapEx levels start to increase. And if that's the case, Mettler Toledo really fits in they make analytical instrumentation. They sit in a really good spot. They earn very high returns on the business, very well-managed business, excellent balance sheet. That one, likewise, we think is ready for some significant appreciation.
And Aaron, either of those, you feel good about it even if the Fed, say, only cuts twice next year? Those wouldn't be a Fed story?
Absolutely. If they only cut twice next year, I think we're protected for one if the equity market were to go the other way because we have excellent balance sheets, good businesses. But the other side of that is there's got to be a reason the Fed is not being as aggressive on cutting rates, and that is the economy is doing well. If reinvestment is happening, employment stays strong or gets better, there's a lot of good reasons to think that these stocks can do well.
Is there any concern, Aaron, about some of the geopolitical risk out there? A lot of stuff happening outside the borders of the United States that certainly have the potential to sort of spill over inside our borders.
Yeah, absolutely. So 2024, we've known for quite a long time, is going to have a really high percentage of democracies globally kind of going to the polls for new leaders. We've seen that. We've seen, changes at the top of many countries around the globe. So we knew there was going to be a lot of political changes that happened last year. I think this administration, has a lot of opportunity to improve relationships in an area where the U.S. has not. And I would say the Middle East is one of those as well. So I'm actually more optimistic that conflict has peaked here, but we'll see. Obviously, it always pays to pay attention to that. We really look at the other thing for next year is really pricing the unforeseen. And I think that everyone is really optimistic this market continues next year. Earnings growth look good, although it's coming from cyclical sectors. But we also look at it and, want to be cognizant of some risk factors that we think may not be foreseen.
All right. Well said, Aaron. We'll catch up with you again next year, I'm sure. Aaron Dunn, co-head of Value Equity and Senior Portfolio Manager at Morgan Stanley Investment Management, kicking us off to the close here on this Thursday afternoon. When we come back, a conversation about Darden Restaurants, one of the worst performing stocks in the first half of the year, hitting a record high today. We're going to talk about why the company expects casual dining demand to get back into full swing.
All right, plus you got almost 1 full year of Bitcoin exchange-traded funds, a conversation about the future of crypto and how ETFs are fueling Bitcoin's popularity with traditional investors.
And speaking of crypto, one of its biggest champions joining us a little bit later to discuss a new venture capital, a conversation with Cathie Wood, the CEO of Ark Invest, and Rebecca Kacaba, co-founder and CEO of Dealmaker, a conversation about the power of the retail investor. All that and more coming up here on The Close. This is Bloomberg.
President-elect Donald Trump is calling for lawmakers to lift the debt ceiling and wants a government shutdown if the debt limit isn't extended or abolished. And this comes after Trump poured cold water on yesterday's budget deal. It's been quite 24 hours in D.C. Terry Haynes, founder of Pangea Policy, saying a government shutdown really doesn't matter to markets. But by turning the political volume up instantly up to 11, a la Spinal Tap, on an issue of no importance, Trump and team show political tone deafness at a moment both Trump and markets would have benefited from one less distraction by tantrum. Nathan Dean, senior government analyst with Bloomberg Intelligence, joins us now. So does the shutdown potentially matter, or it's just a lot of noise where there shouldn't be noise?
No, so the shutdown to markets really doesn't matter. I mean, obviously, markets to those of us in Washington who want to go to the museums over the break. But from a investor point of view, you know, President Trump had a 35-day shutdown under his first term, and the S&P 500 went up. Even defense contractors, you would think, would be somewhat impacted. You know, their defense and their spending programs are 2-3 years in change. So, you know, ultimately, from the market impact, it doesn't matter. And then from the debt ceiling perspective, it doesn't matter either, because the X date, the date when Treasury runs out in order to pay its obligations, probably won't be until the next summer. So this is really just a political exercise, and this is an exercise for President Trump to try and get some of the policy goals before he becomes president.
It does seem, though, Nathan, that the back end of the yield curve is being moved by this. It's hard to find an anchor for that 10-year when the debt ceiling is now in question months before it was going to be an issue. Is the bond market the place to be looking for the issues?
Yeah, you know, so when it comes to the debt ceiling, this is a really interesting fight, because this is a little bit different than how it normally happens. Normally, you have a Democratic president, and then you have fiscal hawks on the Republican side saying, look, we want to use the debt ceiling as leverage to score policy goals. But then you have President Trump coming out and saying, look, I want to get away with the debt ceiling in its entirety. And that's something that a lot of Democrats are on board with. Senator Elizabeth Warren even said that today she'd be fine with that. But the problem is that you've got a lot of Republicans in the House that are uncomfortable with the idea of pushing forward a debt ceiling, raise, extension, et cetera, without fiscal cuts. So you either have a choice. Do you go with President Trump, or do you vote your conscience? Either way, it's not going to be a good voice for them, a no good vote for them, and they're going to struggle.
Yeah, well, and there's been a lack of conscience in Washington for years, so let's not count on that, Nathan. I am curious, though, about the timing of this. Unlike some of the other debt battles, the idea that this is coming at the end of one administration, and for that matter, the end of a Congress, and that you're going to have a new Congress, new leadership, and of course, obviously, new leadership in the White House taking over. I am just curious as to why play out this battle now. What is the advantage for the Trump administration to do this now rather than just waiting to January, late January, February, and dealing with it then?
Well, you know, I think when it comes to the debt ceiling, President Trump was trying to take advantage of the fact that he wouldn't have to increase it under his watch. If there was a way that he could abolish the debt ceiling, and one of the ideas out there is maybe they pass a 2-week funding bill, and then they try and address this before he comes into inauguration, saying, we'll abolish the debt ceiling. But if he can do that, then he takes away one of the leverage points that Democrats can use. And for President Trump, this is all about speed. I mean, the faster that he gets into the office, the faster he moves forward with tax extensions, the faster he moves forward with tariffs. Okay. And so President Trump is pushing speed here.
And how does that actually resolve our budget situation, though? I'm just a little curious about how that pieces together, getting rid of the debt ceiling, implementing these tax cuts and other things with speed. That gets us to a balanced budget sometime soon?
Probably not. I mean, if you look at even Elon Musk in his $2 trillion cut is goal, to cut $2 trillion from the U.S. budget.
Yeah.
The U.S. budget's about 6.7. Majority of that is in mandatory spending.
Yeah.
There's not a lot. But the thing that we're telling to our clients is just remember, Congress controls the appropriations process. So even though Elon Musk can use the bully pulpit to push Republicans into his policy goals, ultimately, you're going to need 7 Democrats in the new Congress to go along with you. If not, you're going to have a government shutdown fight. So in terms of the budget, in terms of deficit spending, there's a lot of challenges ahead for those who want to cut.
Is Mike Johnson going to be Speaker of the House in January?
Obviously, I think his position has been a little bit less and a little bit more weakened. But I would also ask, who wants the job? I mean, there aren't many other opportunities out there for other folks saying, look, we're going to take up a very difficult position. So, we'll see what happens.
Well, a couple names have been floated, including the man with that bully pulpit, Nathan Dean, senior government analyst over at Bloomberg Intelligence. A look at the latest shenanigans in Washington here, another stare down over the debt ceiling. When we come back, we're going to focus on markets and the things that matter, and that includes Darden Restaurants having a phenomenal day, getting back to a record high, impressing investors with its high standards, and more importantly, its outlook for the growth in consumer spending. That's coming up next here on The Close on Bloomberg. All right, time now for our top calls. These are the big movers on the back of analyst recommendations. And we start off today with Netflix. UBS raising its price target to $1,040 a share, up from $825, citing increased conviction in the streaming platform's ability to sustain double-digit revenue and operating income growth. The analysts also saying a robust slate of content this quarter should further drive subscriber growth into 2025. Those shares up about 2% on the day. Next up, let's take a look at Micron, downgraded to neutral over at Bank of America after the computer memory chip maker posted a weaker than expected forecast. While demand for data center and high bandwidth memory for AI remains strong, the analyst says weakness in the PC and smartphone markets are putting downward pressure on pricing. Those shares having their worst drop since at least March of 2020. And finally, Tapestry, an upgrade to buy over at Jefferies, a price target going from a near street low $50 a share to a now street high $80. Analyst Ashley Helgen saying that the luxury retailer can focus on improving sales growth now that deal to merge with rival Capri is kaput. She's particularly sees strong momentum from Tapestry's Coach brand. Those shares up 1% on the day, and those are some of our top calls. Let's go from handbags to steaks now. Shares of Darden Restaurants having a phenomenal day, trading at a record high after the owner of Olive Garden and Longhorn Steakhouse released impressive second quarter results, signaling a return to consumers dining out. Nick Setyan joining us right now, Managing Director and Equity Research Analyst covering restaurants at Wedbush. He has an outperform rating on the shares. And Nick, I want to start off with a comment that the CEO made on the conference call, and I'll quote it directly. Quote, "It looks like the consumer is starting to feel a little bit better than they were in prior quarters." You believe it?
Well, I do, and we're seeing it, in the results of a lot of restaurants. Frankly, restaurants had really priced themselves out of the game for over a year there, and now they're doing all the right things, starting with McDonald's. The $5 price points you have in casual dining, you have very compelling price point promotions now. So restaurants can't roll back pricing, but they can certainly drive mix lower and compete much better with convenience stores and grocery stores who are taking market share over the past year and a half. And so now what we're seeing in the second half of this year is restaurants are punching back and they're winning.
Talk about some of the promotional endeavors that Darden took during the quarter and how that balances out. Obviously, you helped to boost growth and same-store sales, but obviously that can't be at the expense necessarily of profitability and margins. What's the balance?
Sure. So Olive Garden, ran a never-ending pasta deal 4 weeks longer than they did last year. And starting in January, they're going to get back to some price point promotions as well. And this is very similar to pre-COVID promotional cadence. In fact, Olive Garden is still spending 30% less on marketing than they did in 2019. And so, if anything, there's still some more room to catch up. Meanwhile, names like Chili's are spending 3x what they were spending in 2019. So some of the worry going into this earnings was that a name like Chili's was taking market share from Olive Garden, and the fact is that Olive Garden held its own.
if you break down kind of who is spending and where, I thought it was interesting that visits from diners who make about $50,000 to $100,000 a year, those are up, but a pullback among diners making about $150,000 or less, which hurts like the Capital Grills of the world. Can they make up in scale on the lower end diners that they're losing in the upper end?
Oh, absolutely. Longhorn and Olive Garden are 80% of the profitability. And really, the fine dining is not a surprise, right? I mean, there was a lot of aspirational spending during COVID that's now normalizing. And so, the customer that was traditionally a Roadhouse customer was trading up to a Capital Grill, when those stimulus checks were going out. And now we're just seeing a little bit of a normalization. And that'll smooth out over the next year or so. But certainly, that also benefits their brands like Olive Garden and Longhorn.
So let's talk about the stock. Darden is up about 15% at a record high, best performer in the S&P. How much more upside is there for this kind of growth that they're seeing?
But as long as they continue to take transaction share, I certainly think there's more room for valuation expansion, along with EPS and top line upside. I haven't published my new estimate, so I can't really talk about a price target yet. But there certainly is continued upside.
Well, okay, even though you can't give us those details until you publish your report, you obviously have some sense here as we get into 2025, not just how Darden benefits potentially from that resiliency in consumer spending, from the trade up for some folks and the trade down from others. Is that going to be something that you see benefiting everyone in this space, or is it going to be much more specific to Darden and maybe a couple other companies that, I guess, just execute?
I do. I think the whole industry is going to start to benefit this year. I think, the entire industry essentially suffered from, the inflationary headaches that they had to absorb, the margin impact they had to absorb, during the years of COVID. Grocery pricing is up 20%, 17%, now going to 20% this year versus 2019. QSR, McDonald's is up 40% plus in terms of menu pricing versus 2019. The casual diners are in that sort of mid 20% range. So across the board, restaurants, just took too much price, and they're doing all the right things to try to reposition that value proposition and regain some of that lost share. And we're seeing it. They certainly are, getting that share back.
All right, Nick, super appreciate it. Nick Setyan over at Wedbush. Thank you very much. Another stock that we're paying attention to is Newell. They make things like Rubbermaid, for example, like the Tupperware stuff. And you're taking a look at that stock off by about 3.5%. What was really interesting was the read-through of all of this. Apparently, people are buying more higher-end stuff than lower-end stuff, yet the stock is down.
More higher-end stuff from Newell Rubbermaid.
Well, apparently.
Oh,
so, for example,
because I need an example there. Because when I think Rubbermaid, I think little tubs, I think Sharpies. You can't really upscale
they do it like,
that.
hey, coffee machines.
Okay, they make coffee machines.
So
right,
instead of people buying a $30 drip coffee machine, they're spending $300 on like a nice coffee machine. But my hypothesis, I wonder, is if the $300 is actually a trade down from like the $800 machines.
From $300, that's a huge jump. So does a 10x spend, does that get you 10x better coffee? Like what?
I mean, yeah.
Does it really?
Yeah.
I don't drink coffee. So
that's like, oh, you don't. That's right. It's lost on you. But but once you go in for the espresso and the milk foamer thing, you can't go back from that.
Then again, my grandfather made coffee using an old sock. So, that's a whole other conversation.
Cool. Bitcoin's up next. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele, talking about all the assets that have moved quite a bit when it comes to the Fed yesterday. Equity seeing a little bit of a rebound today, but you have the yield curve steepening and also Bitcoin falling out a bit as well. Can't seem to get any stability here.
I'm always curious about the correlations with the crypto space and what we see in the broader markets, particularly when you do have kind of these types of shocks, whether it's economic or political or whatever. Is this supposed to be the hedge? Is it not? Is it just basically just a risk asset? So when risk on is there, it goes up?
I love that you brought that up, because I feel like when I talk to investors, it's both of those things. Like some are investing for animal spirits and some are investing as a hedge against inflation. I find that so interesting that an asset can be both at the same time, and that scratches my head a little bit.
Yeah, absolutely.
All right, well, let's get more information here with Jan Van Eck, CEO of Van Eck Associates. Perfect person to talk to about this. It's been a full year since the Bitcoin ETFs have kind of kicked off, et cetera. What do you see? Like, who's buying, who's in it, and why?
For us, it's been the year of the individual investor mainly that's come in. Obviously, it's very exciting to have regulatory approval in the United States. We're still waiting for institutional investors to come in. We're still waiting for a lot of the big banks, the wealth managers to come in. So there's hopefully good news in our future.
Do you get the sense that it's a diversifier hedge or an animal spirits kind of thing, or both?
Okay, so our basic thesis is that it's going to compete with gold as a store of value, right, in the long term, and that's why we see over the next several years it going to about half the market value of gold, $400,000 Bitcoin. But obviously, short term correlation can be risk on, risk off. What we've done is looked at this next year, and it's going to be the third year of this halvening cycle in Bitcoin. So we think that the Bitcoin dynamics this cycle would be the same as prior cycles. And if that's true, it'll be another good year for Bitcoin. It's the year after where you get those massive corrections.
It's interesting, too, when we talk about Bitcoin, whether it's correlated with anything, whether people are just buying this on a whim, we'd be remiss in not pointing out that some of the run-up that we saw in crypto writ large was also tied to concerns about government spending, about inflation, and of course the strength or lack of the dollar. Going into 2025, where a lot of people are expecting inflationary policies out of Washington, do you think that that would benefit a position or even a larger position in crypto?
I don't know about a larger position, but it's the biggest concern in our outlook for 2025. I call it the year, and I've been calling for this for a while, the year of the fiscal reckoning.
Yeah.
I mean, the fiscal situation in Washington, they have both feet on the gas pedal. They're pushing the economy so hard. I think the Fed is kind of a sideshow. Yeah. So inflation was priced into the market in the last 24 hours. We think it's going to be a persistent concern. I mean, in my mind, if Doge doesn't cut $500 billion, so $500 billion, I think the 10-year, there's no limit to where the 10-year could go.
So I'm so confused right now because we have this Doge, whatever the heck it's supposed to be, that's supposed to cut a mythical amount of trillions of dollars. But then you have this whole conversation today about the president-elect saying abolish the debt ceiling, which I'm like, okay, that's a good idea, but I'm not sure how that addresses our budget issues. Combine that with the fact that you just pointed out, this fiscal reckoning, I don't know, we could have had you on the program 20 years ago and you could have said the same words and it would have been true then.
Right. I mean, you never know what's going to happen. And the alternative to what I've said is look at Japan, right? We've been waiting for 20 years. People have gone bankrupt betting against Japan's ability to lend itself money to pay off its budget deficits, and its debt to GDP is super high. I just don't feel the United States is like that. I also feel like we addressed big policy issues the year after a big presidential election. And now there's an owner, right? One party swept, so they own the problems. And I also think that the bond vigilantes are coming back. And you see commentators like Rick Reeder and others saying, listen, you got to look at this stuff.
Well, just to be clear, though, I mean, they're not trying to own it. They want to get this done now so that it sort of falls on the shoulders of the current Congress and current administration before then they come back in and they say, okay, hey, look what Biden did.
Yeah, exactly. It's more like not pass the buck, but like pre the buck or whatever. Anyway, bad analogy.
Kicking the can.
But like backwards. Kick the can backwards. Okay, but then to that point, it's hard then to know where to anchor the 10-year because if you're going to have a lot of government spending, that's going to maybe hurt growth. Cutting government spending, that might hurt growth. But then limiting a debt ceiling, getting rid of that or making that an issue is also going to wind up hurting that long end. And I'm wondering what you guys are noticing in terms of flows and how you think that plays out next year.
Well, I think most investors haven't realized kind of the reckoning that's about to come, in my mind. So the markets, we've had two fantastic years in the equity markets, and I think investors are pretty complacent right now. So, so this is a time to take profits or trim it. I would, really limit your exposure at the long end of the bond market. That's what we're saying. You can never time the markets that well. I think there are going to be a lot of headlines and more volatility next year. But I do think that if we don't address the budget deficit, not the debt ceiling, that's okay. There's a lot of micro issues. But if we don't take 1 foot off the gas pedal, right? I'm saying we have 2 feet on now. If we don't take one off, it's unsustainable. I mean, everyone says it's unsustainable. And that means that will put pressure on the financial markets. If the 10-year goes to 6%, you can forget equities.
Well, and T. Rowe Price is looking about that for next year as well. Okay, so if you want to go outside the U.S. then, where is that?
I love diversifying away from the U.S. right now. And the way I think about international investing is don't follow an index, follow where you think the puck is going. And one of my favorite macro stories is India. Over the next 10 years, it really should be the size of continental Europe. There's no reason to hold it back. It's got pro-business policies. They've done a lot of government reforms. They've digitized their economy. They're doing all the pro-growth things that you would do. So the market has corrected in the last month or two, so I think it's a nice time to add a little bit.
Why not China?
I think China is a very interesting story. I would stay away from the tariff-risked names, but otherwise I like to point out that in Trump 1, China was behind the U.S., according to Bloomberg Research, behind the U.S. in 6 of 13 key industries. They are now equal or ahead of us in 12 of the 13. So there are some amazing technology stories in China that you can get involved with, I think.
Do you think, though, on the whole idea of investing outside the U.S., do you think there are going to be strong correlations, at least among the major developed economies and markets, or are those correlations kind of broken down to the point where you are truly diversifying if you say go to India, China, or wherever?
Look at India. It's a completely not dollar economy, right? Their economy has nothing to do. On a daily basis, if you look at correlation, sure, they're going to wiggle together. And if you look at the last 5 years, their stock market has actually performed as well as ours. So you say, yeah, what's the point? Why go to India? But fundamentally, it's just a completely different story. Their economic cycle, their monetary and fiscal policies are completely delinked. One can't see that from the charts, but I'm going with that theory.
And just real quickly, only about 20 seconds. Are retail investors really going to have an opportunity to do that, though? Are there enough vehicles out there for the retail folks to invest there?
Some well-constructed ETFs.
Shameless plug. It's fine. He set you up for it.
Absolutely. Jan Van Eck, have a wonderful holiday season. We'll catch up with him in 2025, the CEO of Van Eck Associates. When we come back, we're going to take a look at our stock at the hour. It's a big mover today. Lamb Weston down more than 20%. This after the French fry supplier cut its full-year forecast and, well, some concerns here about its CEO as well as its stability as a standalone company. This is The Close on Bloomberg. All right, time now for our stock of the hour. Watching Lamb Weston down more than 20% on the day after the French fry supplier cut its full-year forecast and the CEO out. Activist pressure from JANA Partners, apparently the cause of that. Abigail Doolittle joining us right now to talk a little bit more about this. There's a lot to unpack here. We talk about a surprise loss in the quarter, and that really rattled investors. They're swinging from profit to a loss. The CEO's out. And we talk about several quarters where this company has struggled, despite the fact that it is the dominant supplier of French fries. I saw a stat that said something like 80 million servings of French fries are produced by Lamb Weston every day. That's a lot of French fries.
That's a lot of French fries.
How are you not making profit off of French fries?
Well, you know, that's an interesting question. I'm certainly doing my part ordering French fries.
Do you eat French fries?
I do. I have French fries in my freezer at all times, actually.
Oh, okay.
Had some just the other day. But in any case, yes, it's an ugly picture. I mean, if we take a look at...
What type of French fries do you have?
These are Alexia, so I'm actually going to now see if they're produced by Lamb Weston or not, because I'm guessing that they produce a lot of different brands.
Okay.
But if I take a look, if I scan some of the comments here from analysts, worse than feared, major miss, lower for the fourth time in a row, lack of visibility, remarkably weak. I mean, it's just ugly. But you talked about the possibility that it could be a buyout candidate, and Stifel is saying that. But they do think that it could be at a much lower level. So at the end of the day, if you were to use the SPLC function within the Bloomberg terminal, basically the supply chain, their top customer is McDonald's. They're giving guidance or commentary that's in contradiction to Darden, that's doing remarkably well. Their Longhorn Steakhouse doing well, Olive Garden doing well. They're saying that the U.S. restaurant business is really down, and they're seeing, you know, less fry eating. I believe what they're talking about there is McDonald's, because McDonald's has been in a little bit of a slump. It is down from its recent high, and they're bringing in the value meal. They expect this value meal to help them. Their promotional meal deals are helping, but consumers are buying the smaller promotional deals. So it sounds as though there's just a big ship here to turn around, and JANA Partners with their 5% holding, which is not even huge, just putting a tremendous amount of pressure on them.
Well, and JANA responded to the results saying, today's disastrous financial results and decision to swap its CEO, requires significant board changes, or in its absence, should be sold. Do we think this is going to wind up happening?
It sounds at least as though Stifel is the one analyst who's really talking about that is a strong likelihood, but again, at a much lower price. What price that is, I don't know. I'm reminded of Pretty Woman, actually, Richard Gere being the takeout and sort of that big bad person. But I'm, here with...
Sorry, what? The Richard Gere and Pretty Woman did what?
Well, his character was he was a takeout buyer. He was basically the Ivan Boesky. And I'm reminded
Remember,
of that.
he wouldn't build stuff.
Yes,
he would take it and strip it apart. And that was the whole part of like the journey of Julia Roberts and Richard Gere.
So Alex and I clearly.
So there was a message behind that?
There was a message.
I actually own that movie. but I'm reminded here with Janet.
Like VHS or something?
DVD. I'm a little bit more advanced than the VHS stage.
I mean, it's an old movie.
It is an old movie. You're right. It is an old movie. But Janet Partners is clearly coming in here wanting to make changes, and Janet William Weston making some changes in terms of getting at the CEO, and let's see whether or not McDonald's promotional meals can help them out.
All right. Well, it's been a tough day for that stock for sure. Abigail, thanks a lot. Abigail Doolittle joining us. All right, we got some breaking news for you. House Republicans say that they reached a deal to avert a U.S. government shutdown with a vote as soon as Thursday night. This comes from Representative Tim Cole. He's the chairman of the Powerful Appropriations Committee. Didn't detail some of the specifics of the plan, but Romaine, we have gotten some trickle out from like Punchbowl and Politico as to what that might be.
I guess the big question here is how unified are the Republicans behind this? More importantly, you're going to need at least, 7 or 8 Democrats to vote along with this. So are they going to sway that? And then, of course, I don't know where exactly Joe Biden's been. But last time I checked, he's the one that's got to sign off on this, not President-elect Trump.
Right.
So I don't know how he feels about this and whether he could throw a wrench into the plans as well.
I should point out, Punchbowl saying 2 things. One, the stopgap has a 2-year debt suspension and disaster aid. And also the new Republican stopgap takes out PBM reform. So if we look at that, I just want to take a look at what CVS is doing. And CVS stock is off the lows, well off the lows of the session. Still down 1.5%, but well off the lows.
All right, we're going to keep an eye on that. Of course, the deadline, the official deadline to get this done is Friday night into Saturday here. Of course, there's always some wiggle room on that. But with the holiday approaching, a lot of questions right now about whether they get this done.
One day in D.C. is like a year. All right, we're going to count you down to the close. 15 minutes away. Emily Leveille is portfolio manager with Thornburg Investment Management. This is the close on Bloomberg.
I think there's consensus bullishness largely around the marketplace, and we meet with companies and investors, and it just seems that everyone is really nervous about going against this market. So I think you've got a very consensus bullish long here, the market. So that also worries me.
Aaron Dunn of Morgan Stanley Investment Management kicking us off to the close just about 50 minutes ago. We marched towards these closing bells with stocks oscillating between gains and losses, but it looks like we could end up with red across the screen once we get to those bells in 10 minutes.
So marching to the close, it feels like we're slowly rolling downhill to the close. And that, yes, we're giving up all the gains that we saw earlier in the day. Even tech was the outperformer, now the underperformer. You also have the semis, obviously led by Micron, which is having its worst day in about 4 years. But still, the SOX index is down now for 3 straight days. The Russell also struggling to get a bid here. And you wonder with triple witching tomorrow, is this churn going to get even worse?
Yeah, and don't forget, we get some earnings after the bell tonight that maybe could reshape the narrative with FedEx and Nike. So maybe a bit of a read here on how we've been spending this at the start of the holiday season. Let's keep things moving here and bring Emily Leveille into the conversation. She's portfolio manager with Thornburg Investment Management, counting us down to those closing bells, which are just about 8.5 minutes away. And Emily, I know you guys are basically kind of bottom-up, fundamental growth type investors here, and I know there are a lot of great individual stocks out there that probably meet the criteria for what you want to invest in. But when you look at the market on an aggregate basis, is there a fundamental case to be made for an extension of this rally?
Well, I think it's really tough in the U.S. right now, and I mean, as your previous guest was saying, when the consensus long, investing is all about expectations and what expectations are embedded in the price. And with the U.S. market trading at close to all-time highs, add in the backdrop of political uncertainty that we started to see today with some of the news around the debt ceiling and Trump. And I just don't think that this market is really priced for any jitters or risks. Now, if we look outside the U.S., which is where we're primarily investing for our clients, we're telling our clients, think about diversification. It's the only free lunch that you get in investing. And markets outside the U.S. are absolutely priced with a much higher margin of safety, and that's what we think is really interesting on an aggregate basis.
What does that margin of safety mean, though, Emily? Because a lot of what the U.S. is going to contend with over the next, few months, to a certain extent, a lot of other countries are also going to have to contend with because they're effectively dealing with our policies as well here. So kind of explain what it looks like to go outside the U.S. and find some modicum of safety.
You're absolutely right. I mean, tariffs are going to affect the world globally, and everyone is going to be affected by that. But I think it's really about what price are you paying for that, right? So you've got the S&P at almost 30 times earnings. 40% of the earnings of the S&P 500 are outside of the U.S. Now you look at an economy like France, for example, where there isn't a ton of good news, but that's a stock market trading in the low teens, and so the implications of that. Tariffs obviously would be negative, but then there are a lot of companies, outside of the U.S. that are domiciled outside the U.S. that actually have operations and generate a good amount of earnings in the U.S., and they're trading at these discounted levels. So what we're trying to look for fundamentally is not really investing in the countries themselves per se, but we do find these price dislocations simply based on where these companies are domiciled.
Right. So Emily, it kind of leaves you open to the growth upside in the U.S., where you get that U.S. exceptionalism, but the price discount from overseas. So that's what I kind of hear you saying. So give me some examples of that.
Yeah, absolutely. I mean, it's not a perfect example, but I mean, I think a company like TSMC, for example, which is a critical player in the semiconductor and the AI value chain, exactly the type of thing that has been, sort of driving animal spirits here in the U.S. for the last couple of years. Look, it's growing its earnings at 30% next year, trading at 22 times earnings, and you cannot make a GPU or an ASIC chip for AI without TSMC. This is a really unique business, and you can only find it outside of the U.S. and Taiwan.
So how do you offset the dollar risk? Because it feels like the U.S. exceptionalism trade is then filtering through to this big dollar rally that seems to be continuing.
Absolutely. And I mean, again, I think I hear you. You have to think about diversification, right? So we don't exactly know when the dollar is going to fall, but if you look at the DXY, it's sort of mid-teens overvalued relative to its history. We don't know when it's going to happen, but I do think that there's going to be a point in time when the dollar really starts to devalue. You look at the fiscal situation in the U.S., you look at some of the implications of these Trump policies, which are frankly kind of contractionary and contradictory. So if you get some of those playing out, you could get a situation where first you get a flight to safety, but then sort of the relative fundamentals between the U.S., which have been so strong post-pandemic, and then some of the other countries like China, where you've got some stimulus coming through, like Europe, where it seems like, you're starting to wake up. And I think that could really, tilt in the favor of ex-U.S.
I am curious, though, too, on that point, and particularly when it comes to what Washington is doing or what they plan to do. We've been talking a lot today about the stopgap funding bill trying to make its way through Congress to avert a shutdown. Maybe that doesn't matter in and of itself to markets, but there's a broader contextual conversation going on right now about the debt ceiling, about balanced budgets, and other things that aren't going to be easy to accomplish. And if they do pursue these things, they're going to have major implications for stocks and stock valuation.
I think you're absolutely right. I mean, I think, this discussion, this reckoning about, are we going to continue with these, pro-growth stimulus policies, or are we going to have to think about, whether we try to make some spending cuts and, close that budget deficit over time? And that's obviously going to have, a dampening effect on growth in the U.S. So, we like to look for companies outside of the U.S., growth companies in particular, that are going to be able to grow, kind of regardless of the macro situation that we find ourselves in whatever country we're looking at. So, a business like Nubank in Brazil, for example, which is a leading digital bank in Brazil and Latin America. Just to give you a sense, I mean, they've got 100 million users and people love their product. They have an NPS score of like 90 for one of their credit cards. I mean, when was the last time you heard about a credit card product that people actually like in the United States? And so this is a business where there's only 15 million people in Mexico where they operate, or 15% of people that even have a credit card. So this type of business is going to be able to grow regardless of the macro situation. Now, there might be bumps along the road, and that's where we really take advantage as long-term investors, to really add positions for our clients.
All right, Emily, going to have to leave it there. Have a wonderful holiday season. Emily Leveille, portfolio manager over at Thornburg Investment Management, counting us down to the close. Stocks now starting to hit, going back to session lows here, I should say, despite the fact that we did get a headline a little while ago that House Republicans say they might actually have a deal to keep the government open.
Yep, and also we have to pay attention to triple witching tomorrow. I think it was like multiple $1 billion worth of options are expiring according to Citi, so that's just going to move markets a lot. And also you have to think liquidity is going to be thin out too, right?
Yeah,
like there's like 4 people probably trading.
Yeah, heading into a holiday week for most people, but stick around. A lot more coverage coming up today as we break down all of your market action with our global simulcast. That simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you to that closing bell, a global simulcast. It starts right now. Scarlett Fu here in the TV studio, Carol Masser in the radio booth, Tim Stenovic also by her side as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A day where we're seeing stocks kind of extend to a certain extent, Carol, that sell-off from yesterday.
Yeah, I mean, it just feels like it's kind of running out of steam, any kind of momentum that we saw earlier, very mellow. Although Tim and I have been talking a lot about that despite the kind of muted moves right now in the major averages, you look at some specific names and you've got some big rallies and some big declines.
Yeah, like Micron Technology, Lamb Weston, just a preview for some of the decliners that I'm looking at that are making outsized moves. It does look like, though, that if the Dow does finish in the green today, I know this is a huge deal for you guys.
Yeah.
It could snap a 10-day losing streak going back to 1974. It was the longest.
You know, I look at today's economic data. I can't remember the last time I paid this much attention to the third revision of a GDP report for the last quarter, but it really kind of reinforces what the Federal Reserve did yesterday.
Yeah, I mean, growth actually moved higher. Business investment was really good. Personal spending was really good. Mike McKee made this point that Scott Bessen's plan for 3% growth based on third quarter GDP, he'd have to actually reduce growth to get to his level that he's targeting.
And that's a good thing, right? I mean, for markets, that should be a good thing. Of course, they're all concerned that growth might actually mean, well, extra inflation. And we saw the inflation numbers come up in that report as well.
Yeah, taking a look there, it just looked like a really sad close, you guys. We're like limping there. Triple witching tomorrow.
All right, we got to get these folks clapping a little bit harder here. I mean, you got one job when you're up there, folks. Clap and cheer. Look at the Santas.
They have hats.
They got it.
That's okay. Festive.
All right, a ho to everyone down there at the NASDAQ. The NASDAQ composite, though, not much cheer on the day. Down about 23 points or 0.1%. The S&P down by roughly about 5 points here. We'll just kind of call that unchanged, not even quite 0.1% there. And we should point out the Dow Jones Industrial Average, as Tim was just pointing out here, rising for the first time in 11 sessions, up 16 points, assuming those numbers hold. That's basically a fraction of 0.1%. And the Russell 2000 down in the red, once again, down 0.5%.
Yeah, Santa a little mellow. Even Bitcoin's down today, down about 4.6%, Scarlett. But if you look at the S&P 500, you've got most names, some up, but most of them more than 300 to the downside.
Yeah, and leading on the downside, when you look at the sector performances, our real estate investment trust losing about 1.7%. Materials and energy also down about 1% apiece. On the flip side, utilities are gaining ground, 0.5%, financials and technology, but those gains are fairly modest with tech only up by 0.2%.
All right, guys, to the individual gainers. Darden Restaurants, your number one gainer in the S&P 500, up 18% at its highs, finishing the day just shy of a 15% gain. Shares rallying to a record after the owner, Olive Garden and so on, raising full-year sales outlook, topping estimates, suggesting casual diners are eating out more, which is kind of interesting. Stock gained as much as I said, about 18% here. So very, very big jump, most, I think, in about 4 or so years. Soho House, that one also soaring in a big way, up 65% at its highs, soaring the most ever, finishing with about a 49% gain after saying it received an offer from a new third-party consortium to buy the company for $9 a share, stock closing at $7 and change. That $9 a share, though, is a more than 80% premium to where the stock closed yesterday, so quite an offer. The offer supported by the company's executive chair and controlling shareholder, Ron Burkle, and also the private equity investment firm that he helms. So that was certainly a standout. And Marvell Technologies, this one was up 3.7% in today's session. This is your number one gainer in the NASDAQ 100. Stock getting a boost from the analyst community. It will become one of the big winners from the rising demand from AI semiconductors, that from Raymond James. They raised their price target to 130 from 120 and reaffirmed their outperform rating on the stock. Stock closing at 109 and change.
All right, you got the gainers, Carol.
Wait,
Sorry,
you know what?
guys, we need to
Before.
get to FedEx.
Yeah,
go ahead.
Go to it.
FedEx, the earnings aren't out just yet, but they are announcing their intent to actually split up two of their key units here. They're going to separate FedEx Freight and create a new two industry-leading public companies. So this is a full spinoff here of the two units here. Again, we talk about these units that were actually brought together not that long ago. The board now announcing here that they plan to separate FedEx into two publicly traded companies. One will be called FedEx and the other will be called FedEx Freight, which will allow them to continue to pursue their growth strategies independently and allow for more customized operational execution. So the real headline here, guys, is FedEx, a singular company, will now become two.
And Bloomberg Intelligence says that unit itself could be estimated to be worth between $31 and $33 billion. We'll get to those numbers more in just a moment. Another headline here, President-elect Donald Trump backing latest GOP short-term government funding plan. He says the GOP deal includes extending the debt limit to January 2027.
All right, and on the heels of that FedEx announcement that it is spinning off its freight business, we also get the numbers for the last fiscal quarter. Second quarter adjusted EPS $4.05. Analysts were looking for $3.98, so that is a beat. $22 billion comes in shy of the expected average analyst estimate of $22.15 billion. Operating margin 6.3% is higher than the anticipated 6.06%, and adjusted operating income $1.38 billion, just slightly higher than the expected estimate as well. In terms of the full year outlook, adjusted EPS of $19 to $20. Previously, FedEx had anticipated $20 to $21. Full year adjusted EPS, again, higher than what it had. Adjusted EPS $19 to $20. Previously, it saw $20 to $21, so that is a paring back of that full year adjusted EPS.
Okay, shares higher right now by a little over 10%, but back to some of the other big news out of FedEx, the fact that the company says they're going to separate into freight and separate FedEx Freight, creating two industry-leading public companies. Here's what the company says about the strategic rationale here. They say enhanced operational focus and strategic execution. They say distinct and compelling investment profiles. They have strong balance sheet and capital allocation optionality. And a shared brand, because they say the FedEx brand represents speed, reliability, and trust, and the values will extend across both businesses, with the new company continuing to operate under the FedEx Freight name.
Got to say, there's more commentary from the company's CEO, and this is coming from Raj Subramanian. He says the Federal Express segment delivered operating profit growth despite several headwinds, including the continued weak U.S. domestic demand environment, as well as the expiration of our U.S. Postal Service contract. And then the company's executive VP and Chief Financial Officer, John Dietrich, he said, I remain confident FedEx will continue to grow earnings this year despite the challenging demand environment as we focus on transforming operations and improving revenue quality. But again, I'm just looking at that remain and just talking about kind of the headwinds that are out there for this company.
And it's kind of interesting because we talk about how these units were, as combined, were sort of the strength of FedEx, at least relative to its closest competitors like a UPS and a DHL. But the idea that this seems to be more about cost savings, at least on the surface, is how I'm reading it here. It's interesting that that's sort of the tack they're taking here. They're also saying that it's going to take about 18 months for this to play out here. They have advisors, but I'm also curious to see who's going to lead these companies. Like, I assume Raj is going to stay behind at the big FedEx and they'll find someone new for FedEx Freight?
Well, I don't know. I mean, their freight business also houses the less than truckload part of their business. And all told, they say that that part of the business was $9.4 billion in revenue in fiscal 2024. But that's really the big news. Plus, you get a buyback now of stock from FedEx as well.
Yeah, not too shabby. Stock's up about 11% at this point. We're going to be talking about this one certainly into the Friday trade. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We'll see you again, same time, same place tomorrow.
And shares FedEx, the biggest mover in the after-hour trade, up more than 12% right now. Second quarter results are out here. Adjusted EPS a beat at $4.05 a share. Revenue of $22 billion, relatively in line with estimates. But the big headline here is that FedEx going to separate into two publicly traded companies. Lee Klaskow joins us right now, the best of Bloomberg Intelligence. And Lee, let's start off with the separation here. A surprise?
Not really. I mean, we knew it was under strategic review, so either one of two things was going to happen. They were going to either spin it or not spin it. So we thought that, probably they would, which it looks like they're doing. They're really trying to untap some value that's kind of lost with the LTL business, the less than truckload business, being kind of stuck in their overall other businesses. LTL tends to have a higher multiple, and it's probably a little more of a compelling industry right now than the parcels market. The parcel market is dealing with a lot of headwinds. They're trying to kind of change their overall network to deal with the fact that growth is really coming from the B2C market, which tends to be lower margin, rather than the B2B market, which is shrinking, as you probably know.
So with the spinoff of the freight business, we know FedEx proper is still very much in cost-cutting mode. It plans to reduce costs by about $4 billion by the end of this fiscal year. Does this spinoff change that goal? Does it allow the company to move to that goal faster?
I doubt it, probably because some of those goals are related to the whole company and some synergies that they can get from all the individual divisions. It'll be interesting to see, as you reported, it's going to take 18 months for the spin to happen. It'll be interesting to see how they separate things, and we'll probably get a little more color and clarification from them. But it does appear that the company is executing on their cost savings. That is kind of apparent by the slight beat that they had in earnings, which we haven't had a chance to really dig into the numbers, but it looks like it's on better margins.
Well, let's talk about those numbers here. They certainly weren't bad. Some actually better than expected. And the forecast for 2025, a little bit of a nudge down here on the EPS side here, Lee. When you put that all together, are we looking at a company that is getting back on track, finding its footing?
Yeah, I definitely think so. I mean, this is like a very interesting story for the longer term, because they went in, into the pandemic, kind of 1 year executing, 1 year not executing. And then, I think what happened during the pandemic is that it was more of a shock to the system where they realized they had to do a lot more for their network. And that includes, what they've done with the corporate structure with combining the ground and express businesses. You're going to see the ground and express businesses prior, they used to operate in two separate networks. A lot of that, you're going to see probably more of a gray area where, some ground network is delivering express packages and some express packages delivering ground, where it makes the most sense. The name of the game in transportation is building density, and that's what's going to drive those decisions, and that should help really drive overall margin improvement over the long term. And they're refreshing their air network. They're replacing older, less efficient planes with more efficient planes. And so over time, and they also changed the whole way they do their air freight network. So that should also drive some significant savings over the long run.
All right, Lee Klaskow of Bloomberg Intelligence, thank you for the instant analysis there of FedEx's results, as well as its big announcement that it is spinning off its freight division. We want to stick with FedEx and bring in Peter McNally. He is Global Head of Sector Analysis over at Third Bridge. And Peter, you and your team have been anticipating, waiting for this potential spinoff. It has come. What does the spinoff now allow FedEx to do that it couldn't before?
Well, I mean, the company has been talking about this, for a few months in a strategic review, but the LTL, business, FedEx Freight, is the most profitable part, that they've got. It's small, but it's growing. They've got some unique aspects, particularly on the southern border in the U.S., where they do well. And generally, this is a good business from a macro point of view. But FedEx, is a bigger story, has always been about something other than the economy, or at least for the last few years. As you noted, earlier, they were playing catch up during the post-COVID era as e-commerce boomed, and then they had to cut costs, for years in this Drive program, and our experts have been telling us that's getting harder and harder to do, and there hasn't been a whole lot of cooperation from the industrial economy. So now we're going to move on to separating into these two businesses now that the cost cutting seems to be done, and that's going to keep investors, focused on that.
I am curious, though, when we talk about how this is going to work. I mean, there's this idea that these businesses, there was some degree of symbiosis to it. I mean, we don't know what the exact structure is going to look like when it's all over, but I assume that umbrella FedEx will still somehow have a stake in FedEx Freight. As an investor, though, do you think you would be more inclined to stick with the big FedEx, if you will, versus the smaller FedEx Freight business?
Well, the multiples are higher if you want to look at the pure plays of the, the LTL business. Old Dominion, Saya, XPO, these things have done well. Now, some of that had to do with the recent Yellow bankruptcy, taking a lot of capacity out of the market. But that's generally a well-regarded business by the market. So I can see where FedEx, would look to unlock some value there in that FedEx freight business.
Peter, what will you be listening for on the conference call today? I mean, heading into these results, everyone was saying that the results were kind of taking a backseat to this anticipated spinoff. That being the case, what would Raj Subramaniam need to say to get more investors on board with what he's announced today?
Well, I do want to hear when they do think a volume turn is going to come. Sort of don't look now, but they did cut guidance for the year. Our expectations are that volumes don't pick up until the second half of 2025. Would like to compare notes with them. But then, how much more cost cutting is coming over these next 18 months until we finally get this separation? They put the stake in the ground for FedEx Freight. So those would be the two things we're really looking for.
I do want to ask you a broader question, Peter, just about the health of the consumer. And obviously, FedEx's fortunes, and certainly over the last few years, has been tied to that boom in e-commerce and the idea that not only are we buying more, but we're obviously buying more online, buying more things that need to be shipped here. When you look at economic conditions and you look at the health of the consumer, is there any concern here that we could see some of these companies that are dependent on that consumer maybe struggle a little bit in the months, if not years ahead?
I mean, it's never straight up and to the right, in an easy path, and it just sort of depends on where you are. And FedEx is working through some challenges, and one of the big ones that they do have today is UPS, who's gotten a lot more aggressive on pricing in pursuing volume. So that competitive dynamic might not tell you everything about the health of the consumer. We would point you maybe look at the airlines if you want to look at transportation. The consumer is doing great in terms of travel. Demand is high. Yes, Spirit went bankrupt, but there were some unique situations there in terms of overexpansion and profit margins. But like big transportation companies, Delta, United, things like that, who are tied to the consumer, they're doing just fine. They're doing actually great.
Doing just fine, but the consumer is picky, and especially at the lower end of the income scale, there's certainly a lot more discernment taking place than there was just a year ago. So which kinds of retailers, which kinds of companies that are exposed to the consumer would you be weary of at this point?
Well, I think the area where we would probably be most cautious on are things overseas. I mean, the U.S. economy continues to do well. Unemployment is low, GDP, strong. The dollar continues to, improve.
Yeah.
It's the overseas areas where we start to see, a bit more concern.
All right, Peter, always great to catch up with you. Peter McNally, Global Head of Sector Analyst over at Third Bridge, keeping an eye on FedEx. Those shares up 10% in the after-hours trade. And Nike now surging 8% in the after-hours trade. Its earnings crossing the wire. A miss on EPS in its fiscal second quarter, 78 cents a share. Excuse me, I take that back. They actually beat 78 cents a share for second quarter EPS. Inventory also came in above estimates at $7.98 billion. Revenue came in above estimates at $12.35 billion. Gross margin came in above estimates at $43.6 million. Those are your second quarter numbers here. Not seeing a forecast in the earnings release. Usually they give it on the call here, but you see, Scarlett, the surge that we're seeing in the shares with, I guess this is the first full quarter that we're now going to, or not the first full quarter, but the first earnings report under the new CEO.
Yeah, Elliott Hill, new CEO, but longtime Nike executive, is at the helm here. And the concern was that Nike had withdrawn its last forecast at the last earnings report, and it hasn't come out with a new one. So I think the focus will really be on what he says regarding what strategy he's laying out here as Nike reports its third straight quarterly sales decline. Even with revenue coming in better than anticipated, this is still, again, the third straight quarterly sales decline. And if you've been going to any Nike stores or even Dick's or any of those other places like Foot Locker, you've seen the markdowns on Nike sneakers.
And Andreeva joining us right now, Managing Director of Equity Research at Piper Sandler. And Andrea, it's kind of interesting, too, to see the commentary in the press release out of Elliott Hill here, saying he's confident that he can make Nike again, and saying he's taking immediate action to reposition the company. I know he's only been on the job for, 2 months now, but are you confident in Hill and what he can do for this company? All right, I think we're having some issues with Anna's connection there. But Scarlett, this gets to the broader issue here of the fact that Hill, for the most part, is an insider. Obviously, he's coming back to the company, but he was an insider for years. He was very well respected, not just for his business acumen, but really for kind of his sense of design and his sense of kind of what the consumer wants. And I think there are a lot of people that feel like they kind of lost their way under the previous management that was much more focused on kind of the operational challenges of running this company, but weren't necessarily focused on, well, let's just face it, kind of the more fashionable aspects of why we buy Nike shoes.
And there's a lot of concern that perhaps Nike focused too much on the lifestyle part of the market rather than the performance side. It gave up a lot of that market ground to the likes of Hoka, likes of On.
Oh, it was a huge opening.
And
it was a huge
now
opening.
the competitive landscape is completely different than what it was when Nike was last on top.
What did they want to be? So like when I see a comment where Hill says, we're going to make Nike again, like what does that mean? Like the Nike that we remember from 70s, 80s, 90s, or something completely new? Because the world is kind of changed and moved on. I don't want to say moved on completely, but it's different.
It's different. All right, let's bring back Anna Andreeva, Managing Director of Equity Research at Piper Sandler. Anna, we were trying to ask you about Elliott Hill, who has only been on the job for a few months and is still, trying to strategize and figure out what his plan is going to be. In terms of what you plan to hear from him, what you expect to hear from him on the conference call, I don't think anyone's looking for a detailed forecast, but what would some concrete plans from him sound like that would encourage investors like you?
Yeah, so thanks so much for having us, and great to be here. So this is a much anticipated first time Elliott Hill on the Nike call. He's been with Nike now for a couple of months, and we think this turnaround, is going to take some time. Like you were saying earlier, the environment competitively has certainly changed. Nike has lost share over the years. Competitors have gained, and it's not just like fighting against Adidas like Nike used to in the past, but there are a lot of pretty formidable competitors out there who have taken share, whether it's On Running, whether it's Hoka, but some of the others like Asics and Brooks and New Balance have all been on offense when Nike has struggled. So Nike is going through franchise rationalization. They talked about it on the last call. It's still early days of that. We would love to hear how that is proceeding. They've said these 3 major franchises will be rationalized by the end of May. So I think timing of that is important, how that's coming in versus plan. And Nike, winning again in performance. Nike talked about running and green shoots in that category on the last call. So we would love to hear, how is that proceeding and how are they planning to bring innovation to market?
So Anna, one other big thing that he's got to deal with, and kind of this is sort of addressing some of the changes that Donahue made when he was there, the idea that Nike didn't necessarily need the Foot Lockers of the world, basically the third-party resellers. It was like, just drive everyone to Nike.com. And for a while that worked, and it certainly showed up in the earnings. But we've seen that work against it. And my question is, what ability does Hill have to not just restore that relationships with those third-party sellers, but actually make them better than what they were prior to Donahue's arrival?
Yeah, no, that's a great point. And I think Hill is cognizant, very much so, of the fact that as a brand, you have to be present where the consumer is at. And that's not just DTC. I mean, that was a mistake under the previous leadership. Hill, being a veteran of Nike, has great relationships in the wholesale space. So we think, going back to some of those retailers will be something that he will be focused on as we look out in the next year. But I think ultimately what's really important is managing your supply tightly. When you manage your supply below demand, obviously as a brand, that's how you regain the heat and the pricing power, which is something that Nike has lost.
Yeah, it has lost, and that'll be Elliott Hill's job primary job is to kind of restore that aura around the Nike brand. Anna Andreeva, thank you so much, Managing Director of Equity Research over at Piper Sandler. We also have some headlines out from U.S. Steel. This is regarding its fourth quarter update, its outlook for the fourth quarter. It sees its fourth quarter adjusted loss of 25 cents a share to 29 cents a share. Previously, analysts were looking for an estimated earnings of 23 cents, adjusted earnings, that is. So it sees a fourth quarter loss of up to 29 cents a share. It still sees fourth quarter adjusted EBITDA of about $150 million. In terms of fourth quarter adjusted EBITDA, it previously saw $225 million to $275 million. Analysts were looking for somewhere in the neighborhood of $261 million.
Yeah, you see the 3% drop in the shares, kind of interesting. I was just perusing through the release here. No real discussion about that Nippon Steel deal. Basically, the only mentions of it in the boilerplate language at the bottom, a cautionary flag there. And it raises the question here as to what is the future of this company as it stands right now, Scarlett.
Yeah, and of course, we're not going to get any answers on that right now with the change in administration over the next couple of weeks. In the meantime, we are continuing to look at the fallout from Nike's earnings and the change in administration and what it means for a lot of these companies that do rely on overseas markets or make their products overseas. We're roughly 1 month away from President-elect Donald Trump's, and businesses all around the world are mapping out their plans to navigate potential tariffs that he's signaled already. Some companies are front-loading their orders, others are seeking new suppliers, and data from Bloomberg finds that companies are discussing tariffs now more than ever before. So we want to get an expert's take. Joining us with more is Sara Hsu. She is a clinical associate professor of supply chain management at the University of Tennessee at Knoxville. Hi, Sara. Great to speak with you. Companies are talking a lot more about tariffs, but there's not much they can do in the meantime, is there?
No, there's not so much. I think stocking up on inventory definitely makes a lot of sense, especially for companies that are very input intensive, particularly in the auto industry. And, you know, especially now that a lot of companies are really reliant on those inputs from Mexico and China in particular. We don't know what's going to happen. It makes sense to have that backup stock.
Did any of these companies learn anything from, I guess, the last, 5 to 10 years? Obviously, we had the first Trump administration, which upended a lot of supply chains. We had the pandemic, which even upended them even more here. So companies have had a lot of time to sort of, I guess, adapt, if you will, to those disruptions. Does that adaptation, is that going to matter in this new Trump 2.0 world?
Well, you would hope so. I know that a lot of companies did a lot of assessment in terms of where the costs are, in terms of where they do production and where they're sourcing from. But the stakes have changed, and it's kind of a moving target. So it looks like now there might be tariffs on Canada and Mexico, whereas before many companies had reshored or nearshored rather to Mexico, and they had also changed production to Vietnam. But now that Mexico is potentially a target, they're really wondering what to do. And so it shifts the game once again. They're going to have to go back to the drawing board and reassess really where to have their supply chains.
Yeah, shifting goalposts seems to be a recurring theme here. So the last time that the tariffs were imposed in the first Trump administration, there were companies that managed to appeal for exemptions from the tariffs, Apple most notably. What does that effort look like, Sara? Because not everyone's an Apple and has that kind of leverage.
Yeah, it's very labor intensive. And I know that a lot of those exemptions sort of died out under the Biden administration. So many companies, even the ones who had exemptions under the Trump administration, are going to have to go through the process again. Of course, you're dealing with the government, so it takes a long time in terms of administration, especially when you have multiple companies who are lobbying for the same things. And it tends to be the larger companies that are politically better connected, I hate to say in some way, that are able to get these exemptions through.
With regards to, though, that what they can do in order to sort of maybe, assuming they don't get the exemptions, sort of what they can do to blunt the added costs here. I mean, I know you just can't reshore. I mean, that's not something you can do overnight unless you already have that in the pipeline. But what other measures are there that they can do to sort of minimize the added cost?
Yeah, I think really, trying to get different sourcing. I mean, a lot of companies, especially after COVID, have looked at diversifying their supply bases. That was a rampant thing. But then after COVID ended and, after the Trump administration was over, things sort of died down a little bit and they were back to doing things like stocking less inventory or reducing their sourcing diversification. So it's something that they're going to have to shift back to again. It is a bit of a nightmare because when we talk about finding new sources, it can take up to years to renegotiate some of the contracts.
All right, Sara, great stuff. Always appreciate you taking time for us. Sara Hsu there. She's a supply chain expert over at the University of Tennessee, Knoxville. A lot more coming up here on The Close. Cathie Wood of Ark Invest. She's going to be joining the program after the break alongside the CEO of Dealmaker, Rebecca Kacaba. We're going to talk about the rise of the retail investor and some of the access to opportunities that have expanded over the last few years. That's coming up next, right here on The Close. This is Bloomberg. We welcome back our Bloomberg Radio, TV, and YouTube audiences worldwide here on The Close with a discussion about unlocking venture capital wealth. That's the mission of our next two guests who are working to expand access to opportunities usually just reserved for the big guys, the institutional investors. Joining us right now is the face of the rise of the retail investor, Cathie Wood. She's the CEO of Ark Invest. You know her. She's joined alongside Rebecca Kacaba. She's co-founder and CEO of a company called Dealmaker, which is revolutionizing how companies raise capital by providing a tech-driven platform for companies to use. Welcome to both of you. And I'm going to start with you, Rebecca. We all know Cathie, and we all know just how responsible she is for a lot of the democratization, if you will, of a lot of investment vehicles. You're also doing something similar, and I'm wondering if you could just kind of explain how Dealmaker fits into that landscape.
Sure thing. So what we're doing is bringing a really technology-driven approach to raising capital. If you think about it, if you reinvented capital raising today, it would be on the internet, it would be data-driven, and it would be democratized. And so that's what our technology brings. It essentially allows you to run ad campaigns and target investors who might be interested in your deal based on their digital profile.
I am curious, Cathie, about these new types of platforms. We talk about the evolution of financial markets. We went from a day and age where financial markets were just for institutional investors. Then you had, of course, the rise of mutual funds, and then ETFs, of course, and then now a lot of new products in the private space are now trying to draw in individual investors. This is just the natural evolution as you see it?
Yes, it's natural in a way, but I think during COVID, it was turbocharged. A lot of, especially younger people who would not meet the accreditation standards, they were learning about new companies, investing themselves, trying to figure out what these new technologies were all about, and happened upon private companies to which they had no or little access. And I think because of that, and because I know we started our venture fund for that reason, they came to us and said, how is it, we don't have enough, we don't make enough money, $250,000 per year, I think it is, and we don't have $1 million in net worth to become accredited and have access to these, incredible technologies early in their lifetimes. Can you help us solve that problem? And so, yes, that's why we started our venture fund. It has no carry. And people can have access to SpaceX and OpenAI, Anthropic, XAI, X for as little as $500.
Okay, so that's one solution to democratizing access of these companies to everyday individual investors. Cathie, could you explain a little bit about what it is that Ark is doing with Dealmaker?
Well, our venture team met Rebecca recently, and I have yet to be briefed on exactly what we're doing together. Maybe Rebecca would want to talk about how far along we are.
Yeah, I think it's opportunities like this where we can understand, we can talk to Washington about what the investors and what the companies want. Like Dealmaker is taking a slightly different approach on it, where we see retail investors having a bit of a distrust of institutions today and companies wanting that one-to-one relationship with the brand. And so we're both two different businesses taking a totally different approach to the retail market, but understanding the power of this and how it can be transformative for the capital markets in a lot of different ways. Because let's face it, there's a lot of ways that the capital markets ecosystem is broken that both what Ark is doing and Dealmaker is doing can help solve.
I was kind of going, I'm sorry, go ahead.
So I was, that's what I thought had happened. We are so like-minded. Charlie Roberts, who leads our VC effort, and Rebecca met at a conference, and we just thought, okay, we're both going at this from in a little bit of a different way from different angles, but this idea of democratization is in its very early stages. So let's make sure we both encourage it.
Right. You both encounter the same issues and you're looking to solve it in your own ways. So, Rebecca, can you talk a little bit about the biggest pain points of capital raising that founders tend to face and how Dealmaker solves for that?
Yeah, I mean, ultimately, access to capital is a challenge for a lot of investors, right? It's very difficult to get VC investment. It actually funds a very small part of the ecosystem. And then there's a lot of brands that retail investors love and they want to participate in, and they can help amplify the business in a different way. So we have technology companies, Monogram's building a robotic knee surgery arm where they've got retail investors forming all of their beta users and really supporting bringing that business to life and driving revenue for them. So the reality is that businesses are built online today, and there's a lot of different ways that retail can interact with these brands to help propel them forward.
Was there any issues when you were starting this, Rebecca, and was there any issues about regulatory concerns? I mean, we know that regulators, particularly here in the U.S., look over their shoulders and they sort of, I think kind of Cathie alluded to, they're saying, look, you don't have the net worth, so you must not be sophisticated enough to buy this type of vehicle. How did you navigate that regulatory side of this when you were coming up with this idea and building out the business?
Okay, well, shameless plug. I think the regulators were brilliant in the way that they designed the legislation, because the legislation protects investors already. So they put a cap on the amount that a retail investor can invest when they're not accredited. So they're not going to lose their shirt on any one single offering, because we know some offerings are going to succeed and some offerings are going to fail. And so the main thing that we're driving for here is to make sure that the investors are protected, and the legislation did that already. And so there's a bill in the House right now that's probably going to pass with the new administration that we're going to see the exemption limits go up from 75 million to 150 million. You've also got Fit 21, which is going to bring a lot of interest to the crypto space. So we see the snowball just rolling now in terms of retail access to alts.
And Cathie, I do have to kind of ask you about the climate in Washington. And I know you have a lot of friends, either business-wise or personal, in the incoming administration coming in. And there's been a euphoria, I'm sure you've seen it, ever since November 5th, even slightly before that, when it became somewhat clearer that Trump was likely going to win. He's promising, obviously, a much more business-friendly administration, one of deregulation. At the same time, he's also pitching fiscal policies that could potentially have some economic impact to the negative side. I am curious as to, I guess, what type of euphoria you're feeling, and more importantly, what type of caution, if at all, you're feeling as well.
Well, if you look at the performance of our funds since the election, they've far outpaced the market, outpaced the Mag 7 and so forth. So I think what the market is beginning to say is this administration is going to support innovative strategies, anything that will accelerate the growth, increase the productivity of our economy. Deregulation is going to be, we think, a very large part of that. Tax incentives, tax rate cuts as well. You mentioned perhaps the cutback in government spending programs. In our mind, government spending, longer term, is taxation in one form or the other. It's got to be paid with increased taxes now, increased taxes later, or basically through inflation, inflating away the debt. So we think that's going to be very positive, this drive towards increasing the efficiency of the government, which will then limit the kinds of tax increases we've seen over the last few years, and perhaps even continue to roll back taxes, leaving more for the private sector at the expense of sort of inefficiencies in the government sector.
So, Cathie, following on that, the president-elect has outlined a number of initiatives that he wants to put in place as soon as he is inaugurated on January 20th. Of the different proposals, the pro-growth items that he has on his to-do list, which do you think needs to be prioritized? Is it tax cuts? Is it immigration reform? Is it tariffs? Is it deregulation? Which of those things should be at the top?
Well, consider the source. So my answer might be different from President-elect Trump's answer. But in terms of turbocharging growth, I think if tax rates, if this administration is going to cut tax rates, the most important thing it has to do is make sure they're retroactive to January 1st of 2025. Because, and we learned this from the Reagan administration, if they defer or phase in tax cuts, businesses and individuals will wait for the lower tax rates, and that can weaken economic activity. Beyond that, deregulation, critically important. I think one of the reasons venture capital has had so much trouble during the last few years and strategies in the innovation space, especially in life sciences, is because M&A has been prevented by the FTC. That is going to change. So we are finally going to have price discovery as strategic buyers bid for these innovative companies. We'll see how much they're really worth. This has not happened in a long time. Yeah. We also think, therefore, there will be liquidity events for private companies into the public world, which is also going to become very important.
Well, Rebecca, I'd like to get your thoughts on that as well, because when you look at the data, certainly in the first half of the year, I mean, VC funding activity was abysmal. We saw definitely a bit of a pickup in 3Q. I'm not sure what the fourth quarter has shown, but are you optimistic we're going to see more VC activity, kind of to the point of what Cathie was talking about in terms of the catalyst? Is that going to really push this industry forward?
It definitely feels that way. It really does. I think the momentum is there. The street is excited and feeling the effects of deregulation. And, you know, one of the benefits that we saw over the down market activity was that retail investors stay strong. Like, while VC activity dipped, retail investment continued to pull through and continued to carry a lot of the capital markets, which was what Congress intended when they originally passed the legislation. So we expect to just consider that upswing continuing.
Cathie, you had mentioned the Ark Venture Fund. I'm wondering, with this new administration coming in, the deregulation that you talk about and the things that they can do to really get the economy going and get companies going, do you think that startups will choose to stay private less? They'll start to look to the public markets as an engine of growth, more so than they have in the past couple of years?
Well, it depends. If there's more deregulation and if the red tape associated with going public starts to disappear, any company that wants to scale very quickly, and especially if they have anything, if they're at a higher fixed cost base, the robotics industry would be one example of this, they would probably scale faster in the public market. So we think it would be fantastic to have both markets operating efficiently, one encouraged by more M&A activity as we change the leadership at the FTC, and the other one just enjoying the lower red tape associated with less regulation. So we think this administration is going to be very pro-business. And is going to be that's going to be a big reason that the growth rate of the economy is going to accelerate in the next few years.
Cathie, I do want to get your thoughts on Elon Musk and his role in this administration, particularly given we know that Ark is invested in many, if not all, of his companies. He's wearing a lot of hats, and now he's got the Washington hat on, in theory, starting in January. I mean, how much do you think he can do, given that he's not technically going to be in an official role? And do you worry at all that his work in Washington might come at the expense of the attention to his actual companies?
Well, I think one of the reasons he is dedicated to this is because his own companies have faced such regulatory pressures and obstacles, and he just knows he could change the world even faster than he already has. If he got some of those obstacals out of the way.
But Cathie, can he do that safely, though? And I'm just playing devil's advocate here. I mean, a lot of those regulations are, kind of meant to kind of protect the consumer to a certain extent from car crashes or whatever. It's one thing to move fast and break things. It's another, to break your customer.
No, I think if you listen to Elon Musk and safety and focus on delighting the end consumer, Tesla has the safest cars in the world. And yet the regulators in the last 4 years have focused on almost every accident and fatality in an accident in a Tesla car, as opposed to in the other 40,000 accidents. So I think that he understands that there is an important place for regulation, that safety of the consumer is paramount, that we're not going to neglect that. Mm-hmm. But there is such a thing as regulation gone too far. I've seen statistics that in the last 4 years, regulations piled one on top of the other, and from different departments have taken 6 percentage points off of real GDP. Yeah. So that has to change.
And also to that point, though, Cathie, and I want to, this question is to you, Rebecca, and it really has to do about the idea of business creation. There's been a lot of stats about how business creation has just shrunk. Now, some of that's just because of the pandemic and a few other things, but there has been a lot of theories about government regulation, government oversight, maybe putting a little bit of a squash on that. Do you hear from that with some of the startups and the entrepreneurs that you deal with on a day-to-day basis?
Yeah, for sure. I mean, when Elon said so himself, right? When Elon can build the rocket faster than he can get it approved to launch, you've got a fundamental problem that's slowing down innovation. So, of course, as a tech CEO, I'm very excited to see what he can accomplish applying engineering concepts to government. As retail capital, from direct to investor retail, we saw even in a down market, 5 issuers that raised on Dealmaker go public on NASDAQ during the last year. So I think as we open up new categories, new ways of building businesses and having those be digital and what that means, there's different things that are going to emerge and different trends that are going to emerge. And definitely one of the trends that we saw was a lot of our companies, our tech and robotics companies, and now more emerging sports teams as well. We're going to see a whole different changing landscape of companies going public sooner.
Cathie, I can't resist asking about Tesla since we were talking about Elon Musk. I know that your funds have been actively trading this week. Ark Fund sold about 164,000 shares of Tesla this week. I'm guessing this is tactical, but I'm wondering if post-election there's a fundamental change in the story when it comes to Tesla.
Well, I think one of the changes, again, back to regulation, is the likelihood that autonomous mobility, so robo-taxis, are going to be regulated not on the state level, so 50 different regulators, but on the federal level. After all, autonomous vehicles will travel from state to state, so it really should be federal legislation. So I think that will speed up the move towards autonomous taxi networks. And I do believe for that reason, investors, analysts are starting to model out what that will mean to the Tesla model. It will take their gross margins from mid-teens right now up into the 60s if we are right, because robo-taxis and autonomous taxi network is a SaaS model. I think the other thing that has happened is more and more people are seeing videos of the humanoid robot doing all sorts of things that we didn't think were possible as the dexterity in its hands gets so much better.
Yeah, and to your point, analysts over at Mizuho do see idiosyncratic tailwinds over the next 4 years for a company like Tesla upgrading their price target there. So when it comes to autonomous vehicles and all that, there are reports that Honda and Nissan are exploring some kind of tie-up, maybe a merger. Would a combined company create a worthy competitor to Tesla or Chinese EV makers even?
Well, I think that anytime there is a combination of two companies, it takes a while for the integration to take place. So if anything, we would think if there is a competitive dynamic from those two companies associated with autonomous, that it will be delayed. More competition for EVs is coming from China, no question. Now, we have very big tariffs already in place to prevent that here in the United States. And we'll see what happens with the administration. I think that Elon Musk is not worried about competition if we're talking about Tesla.
Yeah.
He's driving the cost curves down dramatically for his own company. So he's not worried about losing the EV tax credits either. He doesn't need them. He will be profitable. Tesla will be profitable without them.
Cathie, I do want to pivot here and ask you about some of the market action, particularly over the last few months, and particularly when it comes to crypto. I'm sure you've seen the big run up in Bitcoin briefly above 100 grand. Now, back below that today, but certainly phenomenal run on a year-to-date basis from where it was just a few months ago here. Do you still sort of see Bitcoin really hitting some of those lofty milestones that you've talked about before? 100,000 is still a long way from 1 million. I do kind of wonder how much further you think this could actually go.
Well, what's interesting about Bitcoin today, now that we're going to get more regulatory green lights, we're seeing institutional investors focus on this new asset class. And as they're learning about it, they're saying, wait a minute, this new asset class, or this component of a new asset class, Bitcoin, is going to reach 21 million units out there, 21 million Bitcoin out there at its peak, and no more from there on. Where are we now? We're already above 19.5 million units. And so if institutional investors are looking at this new asset class more seriously, and Bitcoin is really the first of its kind in a new asset class and will be, we believe, the biggest opportunity of them all, they must consider an allocation. And so supply demand, they're doing the arithmetic, and we see 1 million to 1.5 million by 2030. That the probability of that has increased because of institutional.
Okay, so that's 6 years from now. And I understand the supply-demand dynamics. But, Cathie, I'm sure you're also very aware of some of the main criticisms that there really is no, fundamentals, if you will, at least in the traditional sense of how we try to value stocks or hard assets here. So beyond the speculative nature of I buy this and someone will buy it for more than me down the road, is there anything else there that gooses this beyond just that supply-demand equation?
Well, I think it's a very big idea, and it's not just speculative. It's a global monetary system that is rules-based, it is private, it is digital, it is decentralized, and it is backed by the largest computer in the world, or the largest computing system. It's the most secure network in the world. So that's very important. Gold would be in the same category. Gold is a store of value. And it is fairly scarce. What's interesting in the last year, with the last halving this April, the increase in Bitcoin, the number of Bitcoin per year, the percentage increase, dropped to roughly 0.9% per year. That is below the 1% long-term growth in the supply of gold. So it is becoming even more scarce than gold. And the difference between gold and Bitcoin is when the gold price goes up, as it has, production goes up, the rate of increase in the supply goes up. That cannot happen with Bitcoin. It is mathematically metered to go up now 0.9% per year for the next 4 years, and then the supply growth will be cut in half again. So we think you can use gold as a guide in terms of what this asset class is right now, at least. It's very definitely a store of value, a digital store of value, and it's a very big idea from our point of view. You can also go to our big ideas, ArkInvest.com, Big Ideas 2023, and see how we get to that $1.5 million by 2030 in our bull case.
Rebecca, let me bring you back into the conversation here as we talk about crypto and, kind of the growth stage it's in with the change in administration. I'm curious whether crypto companies are a natural customer for Dealmaker in tapping this retail investor base.
Yeah, they haven't been in the past because it was a gray area and, there was a lot of concern about whether it was legal and what they were doing is legal. But we've definitely been considering that on a go forward. I think that will change, which is what the legislation is intended to do. It's intended to clarify what is a security and what is not, and going to be regulated differently as a commodity. And we also think there may be some interest now for people to come back to tokenization. That was big a couple of years ago, and then that totally fell off the radar. It was very hard to maintain the central register for the securities amidst all of the trading activity. But once the legislation gets clarified, we think there'll be, some renewed interest in that.
All right, fantastic to get both of your takes, and really appreciate your joining us and spending some time with us this afternoon. Rebecca Kacaba is co-founder and CEO of Dealmaker, and our thanks as well to Cathie Wood, CEO of Ark Invest, joining us from St. Petersburg, Florida. Thank you both so much. Really fascinating conversation there.
Yeah, real fascinating. I mean, I like what Rebecca's doing, and that when we kind of talk about the democratization of this and the idea this now trickles down to the VC level, not just with the investors, but obviously with the companies themselves.
Yeah.
And then, of course, Cathie's comments about Bitcoin and that sort of 1 million mark, the idea in just 6 years, 2030. I guess it's plausible. I mean, a lot of people were talking about 100,000 earlier this year, and we called them crazy.
Right, and here we are. Yeah,
yeah.
Way past it as well. Yeah. Absolutely. It'll be really interesting to see how her fortunes shift as Donald Trump does take office in January.
And obviously, she's got a lot of ties to a lot of key people in that administration. Let's set you up for what to watch over the next 24 hours. It could be potentially market moving, including a sit-down with San Francisco Fed President Mary Daly.
That happens at 7:30 a.m. An hour later, speaking of the Fed, we get the PC price index. The Fed is more focused than ever on inflation and wants to see fresh progress.
And this is the important one, those monthly numbers, so we'll get a better sense here of what the trajectory has been since the third quarter actually ended. 10 a.m. we get sentiment numbers out of the University of Michigan. And did you know that tomorrow, Scarlett, is triple witching?
Ooh, do you think that's going to add to volatility or take away volatility?
Well, it's supposed to add to volatility. I don't know. Are people still working? I mean, we're just a few days from Christmas. I think a lot of people have checked out after the big Fed meeting yesterday. But of course, we will be here diligently to cover it for you as we do every day. Balance of Power, that's coming up next. Stick around. This is Bloomberg.